Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And markets have turned around quite a bit here over the past week or so, as inflationary concerns over the past week have driven equity valuations, a contraction on equity valuations. We've seen a fair amount of volatility and downside. And the question for many investors is, are we ready for the next leg higher here? So I want to help answer some of those questions based on the data that we currently have. Before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off with an update of the major market indices, where they currently sit. They're not quite there yet where we're ready to resume a bullish trend, but many of them are pushing near those levels. So we want to pay attention to what those levels are to help us confirm and have some confidence in the next leg higher here. Then we'll take a look at the fixed income markets, what the interest rates and fixed income markets are showing us before we take a look at sector rotation. Sector rotation has been a little odd in terms of what we've seen. So it's really important to understand where there's strength in this current market and where there are potential weaknesses. So as you look for a potential upside here in this market or potential downside, where to position within the specific sectors, we'll take a look at the commodities, gold and Bitcoin with respect to the US dollar and how those are currently setting up before taking a look at the economics and sharing with you our ideas here for today. But the primary question that I want to help investors answer from today's session is really an extension of what we started to talk about here last week. Are inflationary concerns overblown, and are markets ready to resume an upward trend? Meaning, are the fixed income markets kind of brushing off the concerns that we've seen here over the past week and keeping rates low, if you will, to allow equity valuations to continue to rise, especially in an environment where corporate earnings are surprising substantially to the upside? So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to share with you my technical research, my economic research, the corporate earnings that we've seen here in this particular quarter to inform our decisions as to how we position in the equity markets going forward. So if we first look at the S&P 500, we are still on this very strong upward weekly trajectory here that we see here on the left-hand side. On the daily chart, also remaining fairly strong here to the upside, strong upward trajectory. The one level that I'll point us to is that last week, after making an all-time high around this 423, 422 level, we gapped lower here. And after a resumption back to the gap level the prior day, that level was rejected yesterday. So we could not break out above that gap level here yesterday. And the question is whether today's market strength is enough for equity markets to push past that gap level. If we push past that gap level, that certainly puts the S&P 500, in my opinion, back into a bullish phase here. Now, if we get rejected here at this level here again, that certainly puts at least this 404 gap level here back into play to potentially refill this gap, because we still have this gap here around 401 that remains unfilled. Potentially a move back to refill that gap before we continue to move higher here. Those are the two levels that we should pay attention to. Now, when we look at the QQQ did manage to break out above this 324 and a half resistance level here on the NASDAQ 100 index, holding that level here today, potentially resuming back to 340. So if we look at technology versus SPY, technology actually looking relatively a little stronger here than the S&P 500 on the open here today. The Russell 2000 IWM ETF largely range around here pretty much since the beginning of February, but so far holding this 210 support level here multiple times, including here just last week. And we are now resuming back towards that 230 range bound high here on IWM. If we do see a breakout here above that 230 level, that certainly puts this into a very nice bullish continuation pattern here for IWM towards 250, 260 or so here to the upside after such a strong move here from 160 all the way into that 210 bottom level here. So that's a $50 move here. So $250 above 230 puts us projecting up to 280 on IWM. So potentially big breakout here for IWM. And if you look at lastly the RSP, the equal weight S&P 500 index, as you can see, remains in this very strong uptrend channel here, very tight and strong uptrend channel here. So as the market cap indices start to look a little bit stronger, while the equal weight S&P 500 index remains extremely resilient and strong, but it has the same gap fill concerns here. So it hasn't filled this gap just yet. It's attempted to fill that gap. If it fails, that certainly puts us back towards 145 or so. But if it breaks out above that gap, then I would say both the S&P and the RSP back into very bullish phases here for the broader market. So quite a turnaround here from last week. And also EEM, while not as strong as domestic equity markets, holding on to this 51.5 support level here. EEM not doing as well because of Singapore and Taiwan, seeing those resurgence in terms of COVID cases, but holding this bottom of the support level here, likely to resume and revisit this top of this range bound level here around 55 or so. If we break out above 55, that starts to put 58 and 59 here to the upside on EEM. So emerging markets not looking as strong, but so far holding support, which provides evidence that equity markets are so far no longer continuing to weaken. Now, when we look at the 10-year yield, so far still remaining around this 160, 165 basis point level here. Multiple attempts above that level has pulled back. Multiple attempts below that level has pulled back here. And now we've recently had that move up to that 170 level last week, also pulling back to this 165 level here. So 165 providing a bit of a magnet here for interest rates. So as long as we stay around this 165 basis point level and we don't see a meaningful move here to the upside, then from my perspective, equity markets can continue to grind higher here in this type of interest rate environment. Now, one thing for those of you that are interested in trading interest rates, even I'm learning more about trading interest rates these days. I'm doing a special session this Thursday at 3:15 p.m. 3 p.m. Eastern. 3 p.m. Eastern, I'm doing a session here with a small exchange with an interest rate trader, someone who used to trade interest rates. We're going to talk about both short-term interest rate opportunities and long-term interest rate opportunities, how you can trade them using the small futures. Like I said, even I'm learning something new. So I'm really hoping that many of you that are watching these interest rates throughout the weeks and months that we've been talking about them, wondering how you can trade them, how you can get access to them, what are the strategies for trading them. We're going to talk all about that here on our Thursday options education session. We're going to talk about trading interest rate futures. So please join me for that. And I have a very special guest, Frank from the Small Exchange, who was an interest rate trader to help us navigate these markets. Then we will take a look at TLT, which is something that I talked about here a few weeks ago, where we've seen this continuation pattern form after a big move here to the downside. This is what we typically call a flag or pendant type pattern or continuation pattern. And we've now had the confirmation of the breakdown below that pattern. That certainly projects TLT substantially lower here to the downside. Now, when we look at interest rates and we look at the inflationary concerns here, this is one where I'm not 100% sure that we're going to see a big breakdown here on TLT. So far, it has held this 135 level here or so. You do have some support around 133 or so. I really would like to see a breakdown below both of these levels for me to say that TLT is moving substantially lower and rates are moving substantially higher here. Where right now we're not quite seeing that evidence that markets or investors are concerned about this runaway inflationary concern here. So for those reasons, I would be cautious to take more shorts here on TLT just yet. But the charts do show that we've seen that breakdown here below that TLT. But so far, holding this 135 support level here or so and bouncing off of that. But if we start to see a meaningful breakdown below 135 and especially 133, then I would say TLT heading much lower, rates heading much higher. Now, looking at the sector rotation data, this is really where the data is a little muddied right now because you don't really see a lot of sectors moving in this particular direction. And then on the flip side, seeing a lot of sectors moving in this particular direction. You really just have a bunch of sectors continuing to move in this general direction. You have energy, materials actually is still fairly strong, but as you can see is tapering off in terms of moving into that leading category here. You have energy moving slightly lower, materials moving slightly lower, financials moving lower, industrials moving lower, and consumer staples moving lower. As you can see, healthcare also moving in this kind of towards that weakening category, even though they're right now still leading, they're starting to weaken a little in terms of there. So you have 6 sectors that have led that are starting to weaken. And then you look at the sectors that were improving, like utilities, was improving, but is now moving back into the lagging category. Communications moving towards leading, but starting to move back into the lagging category. You have real estate continuing to move towards the lagging category. Consumer discretionary still moving to the lagging categories. You really just have technology that is starting to move into the improving category. It's not there yet, but it's moving in that direction. So as we look at the sector rotation data right now, my expectation is that you're going to start to see many of these sectors perhaps start to turn downwards here, especially these sectors that have been leading, these 6 sectors that have been leading. And then we want to see, what we have seen historically is technology and discretionary come back towards that leading category as these start to weaken. So the data is a little unclear at the moment, but that's seemingly what's evolving here at the moment. So as you're looking for opportunities here in this market, it's important that you understand how or which sectors to position, because you have 6 leading sectors that are seemingly slowing down in terms of momentum, but they are still leading. So they very well can continue to lead. We have seen sectors like this continuing to move back into the leading category here. Energy that was starting to slow down came back to life a little bit here. So we've seen that here before, and it's not out of the, for example, we had healthcare that was moving into the weakening and then all of a sudden moving back into it leading here again. So it's all possible, but really, I think technology is the stealth rally here that we're paying attention to as it continued to weaken here, but started to improve over just the past few trading days. And discretionary, a strong move here to the downside in terms of discretionary. Perhaps we'll see starting to see a little bit of improving here, especially when you see, Walmart, in reporting earnings here this morning, moving about $5 higher. We've seen Home Depot also move substantially. Home Depot hasn't moved substantially higher here, but we expect that it's going to see a pretty good move here today. Lowe's also reports earnings, so we expect to potentially see some move here to the upside in terms of Lowe's. So when you're looking at these sectors, we really do see some potential opportunities here in the weakening, in this lagging category to start to strengthen here over the next few days. Whoops. So as we look for opportunities here in the broader markets, let me bring up my charts here again. Whoops. Let's see. So looking at the sectors themselves, as we break down into the sectors, there are 2 sectors that really are worth paying attention to right now. You have XLE, which recently we brought up this double top here. It got rejected at this double top, and then we broke out above this double top. That is a very bullish pattern. When you see a double top that was tested, break out here to the upside. The only concern that I have with XLE is that you have this major resistance level here around $56 or so that goes back multiple years prior to the pandemic, where we had this let's just call it a triangle here prior to the pandemic. So you have a lot of investors that had purchased XLE in this particular zone for multiple years. And then as we get back into this zone, you have all of this supply. Investors who had bought XLE that are now back to break even, that are potentially going to sell some of that stock. So you have a lot of potential supply here into this $55, $57 zone. So as XLE breaks out higher here, I would be concerned that it might be met with quite a bit of selling here. And especially if you look at the long-term trend here of XLE, that certainly puts into some concerns for XLE. And then the other one is XLK. This is that stealth rally that I'm talking about here, a stealth rotation. As you can see, XLK holding this bullish trend line here so far, just last week, testing that trend line, but so far holding it, and potentially, in my opinion, a nice trend line, potential bounce off that bullish trend line and resuming a bit of strength here into that 145, 147 range here. So if we're looking for upside opportunities, tech has taken quite a bit of a hit, potentially seeing some upside here on tech. When we look at the US dollar continues to weaken here. This is the weekly chart here on the left-hand side. And if we zoom into the short run here, we had what looked like a bit of a rising support level here on the dollar, but we've broken below that level, came back to retest that level as resistance, and has now been rejected at that level. So this certainly puts the dollar back into potentially towards the all-time lows around 89 or so, and potentially a breakdown below 89 here to the downside. That's going to have some ramifications on dollar-based commodities. So whether we're looking at Bitcoin, which is one worth paying attention to here also as well. Many of you, trade these cryptocurrencies. Bitcoin pulling back 35% from its $64,000 peak to this $43,000 level, which is the same level that it reached when it first broke out above that major $20,000 resistance level. That's the level that it held, then finally broke out above this level, and now we've come all the way back to retest this level as support. So far, holding this level intraday here today, but that's not to say that we won't see potentially further downside here, especially since we've seen some pretty sizable moves here to the downside in terms of Bitcoin from peak to trough here. So this, so far 35% is the average peak to trough move from Bitcoin. And we do have a bit of, I would say, perhaps some positive divergence here as Bitcoin makes lower low, momentum makes a higher low. So that is potential an opportunity here for Bitcoin. So risk to reward ratios, I certainly think favor the upside here for Bitcoin. And then when we look at gold here, we've been talking about gold for a while, but we've talked about last week how we've reached this this milestone here, and the question was whether it's going to get bounced lower here and continue move lower, or it's going to break out higher here. So we've gotten our answer here on that. Not only have we broken this downtrend, we've also broken above the 200-day moving average. So you have a fairly significant breakout here on gold, which certainly would target this 182, 183 highs here from later last year and the beginning of this year, at 183 level here. So targeting here gold to the upside, especially as dollar continues to weaken. So when we look at the commodity-based currencies and we see dollar continuing to weaken, and we've seen some sizable moves here to the upside, gold, silver, Bitcoin still have some potential upside here. And then when we shift our attention here to the economics, this is really where some of the, I would say, inflationary concerns that we have seen over the past few weeks have started to ease a little bit, partially, I think, also because of the fact that the economic picture that we have seen, the economic resurgence that we have seen here in Q1 has started to slow down a little. We've seen some deceleration across the board. First thing is that unemployment claims do continue to trend lower here, which is good for the labor markets and the labor concerns that we have, the inflationary concerns that we have here, especially if more people return to the workforce. That's going to ease some of the wage growth concerns that some of the inflationary concerns are coming from. When you look at manufacturing index, we've started to see a little bit of an ease on that manufacturing index. This is, I would say, coming back a little bit towards more normal levels as opposed to the explosive, I would say, growth that we've seen off of the pandemic lows. And then you look at consumer sentiment, we've also seen a bit of a decline here in consumer sentiment, as well as retail sales coming in a little weaker than expected. So when you have this type of mixed picture, this really I would say solidifies the Fed's view in terms of how they are currently viewing economic recovery, right? The Fed has been very strong in its stance that they're going to look at the data before they raise interest rates, that they are not going to just take the market's expectation of inflation and use that as evidence as to it's time to raise rates. And if you look at the economic picture, the employment from last month in April, very, very weak. Retail sales, manufacturing starting to slow down a little bit. That's offset to some degree with the hiring we've seen in services, the services PMI increases that we've seen over month over month over the past few months. But we're starting to see some moderation. We're starting to see some deceleration, and this provides further evidence to the Fed as to why they need to keep interest rates low for the extended amounts of time, at least in their words, to the end of 2023. So as the economic picture is starting to fold out here in early Q2, this is, again, I think, providing further evidence that the Fed is not going to raise interest rates anytime soon, that they will keep interest rates low. And that's part of what's kept, I think, the 10-year yield capped at that 165, 170 level, and provides equity investors just further evidence that rates will be low, and that is a reason, if you will, for equity investors to remain invested and continue to buy the dips like we've seen here over the past couple of weeks. So as we look at that as our macro view, that inflationary concerns are perhaps slightly overblown here in the short run, that the longer term macro picture is that the Fed is going to keep interest rates low, especially in the economic picture that we're starting to see. The dips that we've seen here over the past couple of weeks, if they are buying opportunities, how do you position within that buying opportunity? How do you position within these buy the dip plays? So we wanted to highlight a few of the ideas that we currently have on our radar. So I started talking about HACS, the cybersecurity ETF, during our November thematic investment series. And if you remember, I talked about it when it was trading in this $48, $50 range here. This was right before the SolarWinds hack, and that's when we saw a big move here to the upside afterwards on hack. Now, after this big move here to the upside, it's now pulled back largely to the breakout level here around 52, and has formed this, support level here around $54 or so. So we have now a triple support level here around 54. So from a chart perspective, looking very similar to that EEM chart where it's holding the support level, my expectation is that it's going to resume back towards this $58 range bound high here in this resistance level, and potentially break out here towards that $63, $64 level all-time high here for hack, especially as you see the recent hacks on the oil pipelines we've seen here in the US is going to just bring cybersecurity back to top of mind, not only for consumers and businesses, but also the US government, which obviously does not want these types of attacks on US soil. So especially we've seen Biden talk about increasing cybersecurity budgets here in the US. That's going to benefit the cybersecurity companies, and hack is by far the largest ETF in the cybersecurity space, with, I believe, about $2 billion under management just in cybersecurity. And instead of trying to pick specific names within cybersecurity that you think are going to win this particular game, I think it's better to spread your bets around and bet on the whole industry. And hack is certainly one of the ETFs that you can do that, especially with this triple bottom here around 54, and it's currently trading around 55, 56. I think your risk to reward ratio looks attractive to the upside for hack. The second one I want to point you to is XLF, or financials. Financials remains one of my favorite sectors here at the moment because of the rising interest rate and the steepening rate curve environment that we're in, especially as we saw that sell-off here in TLT, and we see the economic recovery that we're currently seeing. Financials still trading at a relatively low valuation relative to most of the market, and you have a technical breakout here for Citigroup. Citigroup forming this double top recently around 75 or so. We've now broken out above that breakout level here. That's the double top bullish pattern that I'm referring to. Targets, in my opinion, easily this 82.5 all-time high here for Citigroup and potentially higher, as we've seen in JPM, we've seen in Morgan Stanley, pretty much all of the major banks here. I think Citigroup is on its way there as well. And lastly, Lockheed Martin. This is our daily play here for the day. Industrials remains one of my favorite sectors here at the moment, especially based on valuations. Industrials are still relatively inexpensive to the market, and Lockheed Martin, one of the inexpensive plays within industrials here. And the reality is that Lockheed Martin has underperformed this sector for a long period of time, but we've started to see some outperformance here as it broke out above this breakout level, came back to retest this level as support, and is now retesting this double top. So very similar breakout levels that we've seen here in Citigroup. We have this double top looking like it's about to break out here to the upside. And that's the opportunity that I'm looking for here in Lockheed Martin, which would target 420 to the upside short term, 440 to the upside in the long term. Fundamentals here look fairly strong here for Lockheed Martin. Valuations are relatively inexpensive at 24 times next year's earnings. And if especially you look at the Biden infrastructure spending plan that is set to come out here in the end of this year, beginning of next year, even if it's watered down, Lockheed Martin defense companies, certainly one of the net beneficiaries of that major infrastructure spending plan. So Lockheed Martin trading at relatively cheaper valuations, and that potential breakout opportunity, I think, is constructive for a move higher here, especially as you're looking for this current market environment. You're trying to find opportunities that are set up well for upside. These are some of the names that we are paying attention to here for today's market. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding as to how I'm viewing this market, especially over the past couple of weeks. If things have gotten a little shaky, now you have a little bit more confidence stepping back into the markets and where you want to step back into the markets. So with that, I just want to thank our members for supporting us and allowing us to continue to do this week after week. If you have not signed up for a membership just yet, a membership is just $100 a month or $750 a year. You can sign up using the link here on my screen. And if you're a first-time viewer, if you're viewing us on YouTube live stream, if you're viewing this somewhere else and you have not used OptionsPlay before and you want to access some of our daily research that we send out to our members, you can sign up for a free trial at OptionsPlay.com. That's a free 30-day full trial that gives you access to everything before you need to become a member so that you can see what we have to offer. And like I said, this Thursday, at 3 p.m. Eastern, we're doing a session on trading interest rates, specifically short-term trading opportunities, short-term trading strategies, how you can trade interest rates intraday using the small exchange futures. I'm learning more about trading intraday or short-term scalping interest rates. We're going to talk to you about some of those strategies, and we're also going to talk about long-term interest rate strategies, what you can use to trade those types of markets. So with that, I hope to see you guys here on Thursday, because like I said, this is a session that I'm learning something new. So I'm sure many of you are going to learn something new, and I hope that you guys are able to just continue to improve your education and your trading opportunities by expanding the types of products and things that you can trade. With that, thank you so much. Have a great trading day, and I'll see you guys here on Thursday afternoon.